Hi guys, Anthony here again, Creativa Solutions, and we're looking at financial accounting for partnerships. We're obviously focusing on the liquidation section. Alright, so I'm going to take you guys through a piecemeal liquidation. I'm hoping you guys have gone to the website and you've downloaded a copy of this particular exercise. Okay, so I'm going to show you what the question is. Okay, all of this can be found on the website www.creativasolutions.com. Follow the YouTube channel and obviously keep in contact with us via the Twitter handle at creativo_s. Alright guys, so good exam technique is obviously to start with the required. Okay, so what am I actually required to do for this particular question? This question says, using a table, complete the piecemeal liquidation and calculate the interim payments to partners. Alright, so if we look at the top bit, the example question is obviously going to paint a picture. Okay, so we've got Bruce, we've got Clark, and we've got Diana. And they're in a partnership trading as BCD Incorporated. Okay, they're sharing profits in the ratio 3:1. Okay, that's very important. We should highlight that purely because we now know how much each partner is going to be entitled to. Okay, so 3 plus 2 plus 1 gives me 6. Bruce will be entitled to 3/6 of the business, Clark will be entitled to 2/6 of the business, and Diana will be entitled to 1/6 of the business. Okay, and obviously the business as a whole, right, will have a certain amount of assets and liabilities and owner's equity. Okay, we know the basic accounting equation is A equals OE plus L. Right, owner's equity and liabilities will give you your total assets. Right, the next step is to obviously get your easy marks in every question. Okay, every question will have a few easy marks. You need to identify what they are, okay, in terms of the element and what balances will they actually have. Okay, so the first account that I've got here is PPE. Property, plant and equipment you should know is an asset which has a debit balance. Okay, so it's positive. If I go to my solution, I'm going to be drawing up a table. Okay, so I'm going to have columns for each and every one of those accounts. Right, so we just saw the balance for PPE. PPE has a balance of 20,000. Okay, let's write that in. Right, creditors / accounts payable, you should know is a liability, and a liability will have a credit balance. Okay, the balance is 5,000. We'll put that in here as a negative. Okay, liabilities representing a negative balance. Bank, you should know is an asset, and that should have a debit balance. Right, so debit bank with 2,000. Right, the next account is goodwill, which you should know is an asset. An asset will have a debit balance so long as it's favorable. Okay, so goodwill 1,800. Right, then we've got 3 capital accounts here for Bruce, Clark, and Diana. We should know the capital accounts are special. Okay, they're credits. So Bruce will have 11,000 here. Clark will have 1,000 Rand there. And Diana will have 5,000 over here. Right, current account, Bruce credit, Clark debit, and Diana a credit. Okay, so you can see that the current accounts are representing their short-term entitlement, okay, in terms of what they've got currently in that particular account as part of the partnership. Okay, if it's a credit, it'll obviously be favorable, it'll be a plus. If it's a debit, it'll be unfavorable, a minus. And if it's a credit, it'll be a positive credit balance. All right, so looking at this, obviously Clark isn't a very good partner in this particular partnership because he would have drawn too much from the business, and hence there's a current account which is actually in the debit balance. Okay. All right, so current account Bruce 1,000, current account Clark minus 200, and current account Diana 1,000. Okay, so those are all the easy marks that we'll get for opening balances. Okay, and have a look here. If I do a check in terms of the totals, owner's equity, and then assets minus liabilities, right? If I look at all the owner's equity, okay, which would be those over there. Okay, capital for Bruce, with capital for Clark, with capital for Diana, and obviously all 3 of their current accounts. Right, that gives me 18,800. Right, and then if I take all the assets and liabilities, if I add up and subtract the liabilities, I'm going to also get 18,800. Okay, and that accounting equation needs to hold true throughout the actual piecemeal liquidation question. Okay, so that's quite a nice check that you can do just to make sure that you're on the right track. All right, if we go back to the question, you'll see at the bottom we've got, due to a slowdown in the economy, the partners have decided, right, to liquidate the partnership. As soon as cash is available, it will be paid to partners in a manner that no partner will have to refund any money to the partnership at a later stage. Okay, that's obviously a clue that this is a piecemeal liquidation. Okay, so we've got property, plant, and equipment that's been liquidated in the following stages. We've got stage 1, we've got stage 2, we've got stage 3. Okay, we've got the carrying amount and we've got the cash received. Okay, so we know there's a 3-stage liquidation here, and we're looking at obviously doing this in pieces. Right, so if I go back to my working, remember we had a few steps that we spoke about in the previous video. Right, if you guys haven't watched that video, please go back and have a look at it. We talked about the theory relating to the piecemeal liquidation. Okay, you can find it on the YouTube channel, and that will show you a little bit of the steps that you would need in terms of the actual application. Right, so when looking at a piecemeal liquidation, obviously we need to close off certain of these accounts. Right, so goodwill we know is a non-current asset. Okay, remember goodwill exists because the partnership is operating. Right, if the partnership is being liquidated, you can't sell that goodwill to anyone. Okay, goodwill is an intangible asset which cannot be bought or sold, okay, as a physical asset, right, in terms of liquidation. Right, so goodwill is actually a detriment to the business when the business chooses to liquidate. Right, then we've got current accounts as well. Okay, are those accounts going to stay open? No, those accounts need to be closed off as well, because the only account that should be open are the capital accounts for each of the partners, because that represents their ownership. Right, so step number 1 is obviously to close off current, okay, accounts. Alright, so I'm going to close off the current accounts. Okay, Bruce will obviously have minus 1,000 here. Okay, Clark will have plus 200 there, and Diana would have minus 1,000 there. Right, so we're taking away their current balances and we're allocating it to capital. Alright, so Bruce is going to get a plus 1,000 there, Clark's going to get a minus 200 there, and Diana's going to get a plus 1,000 over there. Right, and we also need to close off goodwill, okay, to the partners. So if I close off goodwill, right, remember the profit sharing ratio was 3 to 2 to 1. Okay, so 3 parts to Bruce, 2 parts to Clark, and 1 part to Diana. Okay, they're each getting a part of that goodwill. Right, so goodwill will come down with 1,800. Okay, Bruce is going to get how much of it? Well, remember, okay, we're allocating that goodwill to the partner in their profit sharing ratio, which in this case was 3/6. Right, and I'm going to appropriate that as well, okay, to Clark. So Clark gets 2/6 and Diana gets 1/6. Alright, so if I add up those amounts, I'm going to get the 1,800, which is going to be appropriated to those partners. Okay, alright, so if I look at the current balances after having closed off some of those accounts, I'm going to be left with what? Well, let's have a look. Okay, my PPE, 20,000. Creditors, minus 5. My bank, 2,000. My goodwill is a 0 balance now. Capital for Bruce, capital for Clark, capital for Diana. 0 here, 0 there, and 0 for current account Diana. Right, and again, if I'm keeping track of my owner's equity and assets minus liabilities, right, you'll see if I add up, okay, all of my owner's equity, which in this case represents that, and I add up my liabilities and assets, okay, I'm going to land up with 17,000, 17,000. Okay, and that needs to hold true because the owner's equity comprises of their assets and their liabilities. Right, because of the accounting equation, what's on the left and what's on the right needs to balance off. Okay, so that's where we are currently. Okay, looking at the scenario, do we have cash available? Yes, we've got 2,000. We still have assets and we still have creditors. Okay, so remember, partnerships have unlimited liability. Partners will get paid out nothing if there are creditors that need to be paid, okay, or liabilities that are outstanding. Okay, so the first step is to allocate or to pay off creditors, right, with the available cash. So how much cash is available here? 2,000. All right, so we'll remove 2,000 there, okay, and we'll be allocating that to our creditors. Okay, and our creditors will obviously decrease by 2,000. Okay, so again, if I'm keeping track of balances, okay, right, those are the balances that I've got. Okay, for property, plant, and equipment, creditors, and then capital for Bruce, Clark, and Diana. Okay, so let's go back to the question and let's look at our first stage. Okay, stage number 1 says we sold PPE with a carrying value of 5,000 and we received cash of 5,000. Right, so we sold that particular item of property, plant, and equipment at fair value. Okay, it was worth 5,000, you sold it for 5,000, there's no profit or loss. Right, so stage number 1, okay, obviously there's proceeds received from the sale of PPE. Right, so my property, plant, and equipment is coming down by minus 5,000 and my bank is going up by 5,000 because I'm realizing cash. Okay, that's the first stage in liquidation. Okay, so again, if I sum up, I'm left with those balances. Alright, so you can see in this particular question, okay, you've got bank, okay, which has cash, and you've got creditors, and you've got property, plant, and equipment. Again, you need to pay off the creditors first before any amounts can be allocated to the partners. Alright, so we take 3,000 Rand from the 5,000 Rand cash available and we allocate that to the creditors. Okay, once you've paid off your creditors, are you now in a position to pay off the partners? Yes, you are. Right, so again, if I add up those three amounts, I'm looking at the owner's equity. The owner's equity here is 1,700, right? And the equity, the assets and the liabilities are also making up 17,000. Okay, 17,000 equity here, 17,000 assets and liabilities. Right, so looking at this, do we have a scenario where there is cash available? Yes, we do. How much cash is available? 2,000. Okay, do you agree 2,000 isn't sufficient to pad all the partners? Right, we've got one partner here, Bruce, with 11,100. Good partner, lots of capital invested in the business or still invested in the business. Clark only 200. And then Diana, 5,700. Right, so now who gets the 2,000 Rand cash? Do we pay it out to Bruce? Do we pay it out to Clark? Or do we pay it out to Diana? Well, they're going to probably be fighting over the cash. Right? They're all going to want the cash because they all want to liquidate the business. Right, so when you have a situation where there is existing assets, okay, brackets still needing to be sold, okay, and there's cash available for distribution, we would then use the loss absorption capacity method. Alright, that's the only time when the loss absorption capacity method will be applied, okay, is when you have cash available to be distributed and you've got partners, okay, which don't have the same capital balances, and obviously there are property, plant, and equipment that's still existing that needs to be sold. Okay, so this is a separate working. Loss absorption capacity method. Okay, the loss absorption capacity method is going to be looking at what we said earlier, the maximum anticipated loss. Alright, so remember we said that currently that's the owner's equity that's available, 17,000. Assets minus liabilities, okay, 15,000 plus 2,000. Right, so what does loss absorption capacity method say? Well, loss absorption capacity says if I'm going to have a maximum loss, i.e., let's assume that I can't sell any of the remaining property, plant, and equipment, the 15,000, and I have 0. So if I make this a 0, okay, who is going to have capital left over, i.e. the capital that's equal to the remaining asset, which is bank in this case, because there aren't any liabilities, you've paid them off. Okay, so when looking at a maximum anticipated loss, we're actually looking at what do each of the partners have, or their entitlement, after having sold, or not sold, but anticipated the maximum loss. Okay, so max loss here, loss absorption capacity method, okay, would be minus 15,000. See, that's the assumption I'm making. I'm assuming I can't realize anything. Okay, so i.e., if I had a maximum anticipated loss, remember this is only theory, it's just to work out who or how much they're entitled to. Okay, so if there is a loss of 1,500, who would carry the loss? Well, again, we need to take the loss, okay, and we need to multiply the loss by their profit sharing ratio. Okay, so how much of the loss does Bruce get? Well, 3/6. Clark gets 2/6. And Diana gets 1/6. Alright, so that's the maximum anticipated loss that you've got. If I add up all those amounts together, I get 1,500. Okay, what does that represent? It represents the maximum anticipated loss that will be allocated to the partners. Right, so if I look at this and I put a total here, okay, who's still in a good position? Well, if I take Bruce's amount and I subtract the loss, okay, and I do that for Clark and Diana, you can see that Bruce is still going to have something after having sustained a maximum loss. Clark will have nothing. He's actually owing the partnership now because he is supposed to pay 5,000 of the loss, but he only has 2,000 of capital in the business. So the minus 4,800 is actually something that he is going to have to pay to the partnership. But because it's a piecemeal liquidation, we're looking at paying out the partner who still has something in the business and then paying out the rest later. Alright, so Diana, good or bad partner? Good partner. She still has 3,200 of equity left in the business. Alright, so remember, these partners are jointly and severally liable. Right, so who carries Clark's loss? Well, Clark's loss is actually carried by Diana and Bruce. Okay, because those are the two remaining partners in this particular business. Alright, so this loss needs to be carried by Bruce and Diana. Right, and now if we've only got Bruce and Diana, we've got 3/4. Okay, because Bruce has 3 and Diana has 1. 3 parts to 1 part. Okay, so here 3 parts of the loss would go to Bruce and 1 part of that loss would go to Diana. Okay, so 3/4 and 1/4. You're allocating that loss to each of the partners. Right, so again, if I look at the total, does Bruce still have anything left? Well, if I add up those two, he has nothing. Obviously, Clark has nothing, and now Diana is still left with something. Okay, so if you look at that, who is the responsible partner? Well, the most responsible partner in this particular example would have been Diana. Right, and that's the loss absorption capacity method. Okay, we're taking owner's equity, we're allocating maximum loss in terms of the remaining assets left over, and we're seeing, does anyone have anything left over? Okay, in this case, Diana does. Right, she does have equity, so if there was a maximum loss of 15,000 in terms of the PPE, the only person that will get out anything is Diana. Okay, because based on her capital, she has the most invested in the business, and she hasn't taken that much from the business, and there is still capital owing to her as the partner. All right, so all of this is just the working. Okay, we do this working to then look at the actual allocation or interim payment. Right, so I'm just going to quickly take the totals from above. Okay, so equals that amount over there. Okay, and those are all the totals that we have from above. Okay, those are the current balances at stage 1. Okay, prior to the interim repayment. Okay, we now know who gets this 2,000. All right, who did we say gets the 2,000? Diana. Why does Diana get the 2,000? Because she still has equity in the business, even after sustaining a maximum anticipated loss. All right, so minus 2,000 here. Okay, Diana will have minus 2,000 there because her capital is being reduced. She's getting paid out. All right, so if I then take a total column, okay, let's add up, let's add up, let's add up. Okay, and those are the balances that I'm left with. Again, if I went with this owner's equity equals assets liabilities, you'll see your owner's equity is that. Okay, and your assets and liabilities amount to that. Alright, so you have to have the same amount on both sides. Owner's equity is 15, assets liabilities 15, and that's what we've got there. Okay, let's have a look at stage 2. Alright, so what happens in stage 2? Well, stage 2 says you sold 5,000 Rand worth of PPE and you realized 4,000 for the sale. Right, so good or bad? That's bad. Okay, you've actually sold something worth more for less. Alright, so stage 2, second liquidation. Right, how much property, plant, and equipment did I sell? I sold 5,000 Rand worth of it. I only realized 4,000 Rand cash. So where does the difference go? The difference is going to be viewed as a loss that's going to be debited to the capital accounts for each of the partners. Okay, so allocation of a 1,000 loss to partners. Okay, so each partner is going to be allocated a loss. This partner is going to receive 1,000 times 3/6. This partner 2/6, and this partner 1/6. Right, so that's the maximum anticipated loss. Not loss, that's the loss in terms of the sale. Okay, all right. So again, just to round off to the nearest rand. Okay, just to avoid any decimals. Right, those are the amounts that are going to have to be shared between each of the partners in terms of a loss. All right, so let's put a column for the total again, and if I sum up this, okay, this is a loss, so this minus the loss, okay, and that's what we've got. Okay, let's round off again. Alright, so you can see, looking at this particular stage, okay, Bruce, responsible partner. Clark, irresponsible partner. He is actually going to have to pay something toward the business because his capital account has now changed to a debit balance. Okay, meaning his capital isn't sufficient based on the current scenario in terms of having carried a loss for this particular business. Okay, in terms of the loss on sale, in terms of the liquidation for the partnership. Okay, so again, if I had to add up the owner's equity, okay, and the assets and liabilities, right, you'll see here on the right that I've still got 14,000 equal to 14,000. So everything balances all fine. Okay, do I have cash available? Yes, I do. Okay, if I have cash available, okay, remember partners are going to be fighting over this capital that's still going to, or this cash that's still going to be there in the business that needs to be allocated to each of the partners. Okay, so again, what do we need to do? Well, PPE, there's still PPE to be sold. Okay, looking at bank, there's cash available. Right, would loss absorption capacity method apply? Of course it will. Okay, so separate calculation. Alright, so again, max loss. I'm assuming minus 10,000 as a maximum loss. Okay, so who would sustain that loss? Well, each partner gets a share. Alright, 3 over 6 for the one partner, 2 over 6 for the other, and 1 over 6 for the last. Right, so if you look at that particular table and we look at their balances after this loss, okay, I would then consider Bruce still having a balance, Clark having a very bad negative balance, okay, and capital for Dana, right, 1867. Okay, again, looking at this, there's a loss here for one partner that the other two partners are actually carrying. Okay, so this is going to be a loss that will be allocated to each partner. Right, 3 over 6 for that partner, and not 3 over 6, I apologize, it's 3 over 4 for that partner, and 1 over 4 for that partner. This times 1 over 4. Right, so if you look at that, if you add those two amounts together, I'm going to get, there should be a minus there. Okay, there we go. Alright, if I add up those two amounts, I'm going to get the 3467, which is what's being carried by each partner. Okay, so again, let's sum up. Sum up. And you can see here, we're left with 3,000 there for Bruce, 1,000 there for Diana. Right, so in this particular stage, both partners are going to get paid out a portion. Right, Clark will get paid out 0, Bruce will get paid out 3, okay, and Diana will get paid out 1. Okay, 3,000, 1,000 of the 4,000. Alright, so again, let's just put a note here for balances. Okay, and then second interim repayment. Okay, and the repayment, well, let's first put the balances. Okay, so the balances I would have taken straight from up here. Okay, those are the balances. Alright, so the second interim repayment would have been minus 1,000 for Diana and minus 3,000 for Bruce, minus 4,000 there in terms of the cash. Okay, so balances after the second interim repayment is as follows. Okay, those are the current balances that we have in this particular partnership. Right, so again, Bruce is still in a good position. Clark's doing very badly in terms of having had to have sustained a loss, okay, from that sale of property, plant, and equipment at a loss. Okay, a debit balance on his capital, and Diana obviously with a credit on her capital. Okay, so again, if we add up property owner's equity, okay, and assets minus liabilities, right, obviously there's the capital. Okay, so again, just keeping track, and this is the assets minus liabilities. Right, and then the final stage, stage 3, third liquidation stage, you're selling the remaining 10,000 Rand worth of PPE for 2,000 Rand cash. Okay, so stage 3, that's a really good stage for the partnership because the assets have been sold for more than its carrying value. A profit has been made. Alright, so sale of remaining PPE. Okay, there's a profit that needs to be allocated. How much PPE did I sell? 10,000. Okay, in terms of bank, we realize 12,000 Rand cash. Okay, there's a 2,000 Rand profit. The profit needs to be allocated to the partners. All right, and the profit is obviously a share of 2,000, which is each partner gets 3 over 6 for this one, 2 over 6 for that one, and 1 over 6 for that partner. Alright, so if we're looking at their balances after that particular working, okay, we currently have partners with those balances. Right, and if you look at this, all of those balances will add up. Okay, so my question to you guys is, will loss absorption capacity method apply now? Think about it. Well, the answer would be no. Why not? Well, if you look at this, I've got cash that's available. Okay, so loss absorption capacity method. Okay, when will it apply? We need to check option 1. Option 1 is, okay, is there cash available for distribution? Right, and the answer is yes. Okay. The second point is, are there any remaining assets that still need to be sold? All right, and the answer is actually no. Okay, so would you need to do loss absorption capacity? No. Well, remember, we only do loss absorption capacity when there are still assets to be sold and there's cash available. So here, there is cash available, but no assets to be sold. Okay, so you'll agree with me, right, that this is actually the payout. Okay, that's the capital, that's the final payout. Okay, so final repayment of capital, okay, and each partner will get paid out that particular share, right, of their capital. Okay, and where does that come from? It comes from the cash, right? And you'll see at the end of a loss absorption capacity method question, you should always land up with zeros for all of your columns. Okay, because this is a liquidation, none of the columns at the end should ever have any balances left over. Alright guys, and that's the loss absorption capacity method. Alright, so I hope you enjoyed this video. Please, if you enjoyed it, give it a thumbs up, and please write any comments below, okay, as part of the video. Send me questions if you have any questions. I'd be happy to consider it for future reference. Thanks guys, all the best.